I think chapter number 17 in your book, NF7 BBB. I mean, whatever chapter it is, we don't care. We only talk about standards. So we are going to discuss two standards. One is IS 8, accounting policies, changes in accounting estimates and errors. And second is IFRS 5, which is non-current assets held for sale. The chapter is about reporting financial performance because these two standards, sometimes they create some, how to say, differences in your financial reporting. Now, the thing is, like, there are two things. One, if I start with IS 8, which is changes in accounting policies and estimates. So you should remember that accounting policy is a different thing and estimate is a different thing. So there are three things we are going to focus on: policies, estimates, and errors. Accounting policy, like every company, they need to create their own accounting policy. And so two companies, they might have different accounting policies, but they still remain within the frame of IFRS. For example, this is the framework of IFRS, and your accounting policy is within here, and probably someone else's accounting policies like this, some overlapping and some differences, but both are within the boundaries of IFRS. Now, what do I mean by accounting policies? For example, some companies, they decide to show non-current assets on fair value. Some companies, they decide to show it on cost model. Somebody shows it on revaluation model or probably on cost model. Then similarly, how do you decide about the depreciation? I mean, what is your accounting policy about the useful life of your motor vehicles? Are you taking it 5 years or 4 years? So then how do you treat, what is your accounting policy for charging or calculating the cost of sales? So accounting policies, these are the set of rules which each business, it decides for itself that how are they going to perform their accounting activities. And of course, because IFRS gives you options, you can do like this or you can do it another way. Both options, there are, in many cases, you've got two options given by IFRS. So which one are you choosing? So you have to put it, I mean, in writing. And accounting policy is like a long document. I mean, if you see, in reality, accounting policy could be 150 page document. So whenever a new accountant comes in, how do you tell him, how do we do accounting? We give him the accounting policy. See, this is our accounting policy. This is how we perform our accounting. I mean, the transactions and all that procedure stuff. Now, policy and estimate are two different things. Accounting policy is like, which depreciation method are you going to use? Are you going to use straight line method for motor vehicles, or are you going to use reducing balance? So you've got two options. And you say that I'm going to use reducing balance method. This is a policy matter. This is a policy matter. Now, estimate is a different thing. Estimate probably is that what is the residual, or what will be the residual value of this motor vehicle at the end of 5 years. You say it will be 20% of its cost. Now that is an estimate. Okay, this is not a matter of policy. The useful life is 4 years or 5 years. Maybe you decide 6 years. That's an estimate. But how do you depreciate? That's a policy. And you should remember that changing the accounting policy is quite difficult. I mean, you cannot change it just for the sake of fun. There are specific reasons given by IFRS, the circumstances under which you are allowed to change an accounting policy. It is not possible that year over year, 1 year you say, I'm going to use reducing balance, and the next year I will use straight line. It does not happen. You cannot change. There should be a valid reason, and there are some, valid reasons under which you are allowed to do that. They are given by IFRS. But accounting estimates, they are rather easy to estimate, because this was your estimate. Okay, you decided that motor vehicle will have a life of, for example, 5 years, or some particular asset will have a life of 6 years. After using the asset for 2 years, you realize that the asset is not of that good quality which you initially perceived. So you have a right to change the life. Changing the estimate is possible. Maybe the asset has some major breakdown, and because of that, you need to reduce the life of the asset. So estimates can be changed. And of course, then there are errors, some miscalculations or whatever. So this is our first topic. Let's start this one: changes in accounting policies and estimates. So discuss the principle of comparability in accounting for changes in accounting policies. Now, we know that financial statements, the qualitative characteristics was comparability. This was enhancing characteristic. And comparability means that you have to present financial statement in like 2009, you call it 2009 and 2010. So this is how you present your financial information, like two comparative periods. And you can only make comparison if the financial statements, they have been prepared using the same policies. When you come in and you say that in 2009, my profit is, 3 million. And then you say that in 2010, our profit is 3.5 million. So initially it looks like that in 2010, there is probably some growth. Profit has increased, so it looks good. But then if you tell me that this 2010 profitability, you calculated using a different method, and in 2009, you used some different approach. So if you changed your accounting policy, if you change the way, how do you calculate profit, then I cannot make a comparison between these two numbers. Your comparability or your comparison is lost. You can only compare if you come in and say that, see, I used some policies and the same policies I continued. I never made any change in my accounting policy. I never made any change in my method. I am using the same calculation method, and this is how the results they look like. Now I can make some meaningful comparison. So it is very important to have consistency in your accounting policies, because if you are losing consistency, then you lose comparability. And then account for changes in accounting estimates, changes in accounting policies, and prior period errors. This is something very important, very important. I will speak about a word on it by the end. And discuss the importance of identifying and reporting the results of discontinued operation. This is IFRS 5. This is our next standard, next part of the lecture. Okay, so define and account for non-current assets held for sale. This is discontinued operation. So this is the entire, summary of the chapter. So I'll make a very quick. So this is your first part of the chapter where I'm talking about IS 8, and this is IFRS 5. So let's keep it on one side for a while, and let me even block it. I can even block that thing so that you don't get, you don't get distorted. So we only talk about this IS 8. I'll just make a very quick summary. We don't want to spend a lot of time on this. Accounting policy and estimates. Accounting policies, I explained to you before that you cannot change so easily. You need to follow the rules. Estimates are your choice because you made the estimate and you can change it. And then prior period errors. Prior period error means that probably you made some error in the previous year in your calculation. Probably you did not calculate it correct. Maybe you did wrong calculation. So what do we do with that? For example, if I tell you that there is a situation, we say that, last year depreciation was wrongly calculated as, 100K. It should have been, 140K. So it looks like that in previous year, you charged less depreciation and therefore you calculated more profit. So this 140,000, so there is a 40,000, there's a 40K difference. And the question is that how to treat it? How to treat it? Can we, charge it to current year P&L, because we have to show this expense. So we did not put it in last year. So can we put it in this year? And the answer is very big no. And I will call it again no. And I will call it again no. So that you never make this mistake. Always remember, any type of error, whether it is regarding depreciation or it is regarding any other thing, which belongs to last year, you can or you should never be charging it to this year. Because income statement is 1 year activity. Income statement, it starts with the top line, which says revenue. And that is revenue for this year. And below that revenue, you will only show the expenses which you incurred to generate this revenue, okay? So I'm showing my revenue for 2010, and then I'm showing my expenses which I incurred to generate this revenue of 2010. Anything which does not belong to this revenue should not be coming down. You have to do matching principle, okay? Matching principle. Income and expenses belonging to one period should be recorded to the same period. So if you ever made a mistake in last year calculation, it does not give you, or it does not give you this, flexibility to, okay, last year I did not charge 40,000, let's charge it here now. Tax is the only exception. Forget about the tax, okay? Keep the tax IS 12 on one side, other things you cannot do. So what you should be doing, you should be charging it to retained earnings. Because whatever profit you calculated last year, maybe you overestimated profit last year because you did not show the correct expense. So last year profit was overestimated. And this overestimated profit, where did it go to? It landed it in the retained earnings. So go and just reduce the retained earning. What you should do, you should say debit retained earnings. So you decrease your retained earnings, because if you had treated it properly last year, retained earning would have been less. So my retained earnings are more. They look more because last year I did not show my expense. So the best way is go and just make a debit to retained earning. So you don't make adjustment to P&L. You don't make adjustment to income statement. You just make an adjustment to the equity section. You say debit retained earnings. I mean, this 40,000 should go to retained earnings. And you can say credit non-current assets or whatever. So this is how you should be treating the prior period errors. So I'm just saying that always remember, they will create different type of scenarios. It could be depreciation, it could be about provision, it could be about many other things, but you should not get yourself confused. Should I do it or not? I wrote it 3 times. No, it's not possible. Anything belonging to past year, I will not allow it to come into my this year income statement. Tax, I keep an exception. Leave tax on one side. Other things, answer is straight no. So prior period errors, they affect the retained earning. Maybe you charged more. Let's suppose that you charge 100K and I'd say that it should have been 70K. So it means that last year you charge more depreciation. So when you charge more depreciation, you decrease the profit. Your profit should have been more, but you made it less. So, I mean, I need to make adjustment. So I need to increase profit. And where did the profit go to? The profit went to retained earnings. So I need to increase my profit. Okay. So go ahead and increase in retained earning. You should say, I don't know, whatever, debit here, non-current asset or accumulated depreciation, whatever transaction you made, I don't know, anything. And credit should be retained earnings. Like this. So debit retained earnings, credit retained earnings. Always remember, anything on the balance sheet, wherever you have the balance sheet, when you write off something on the asset side or you increase or decrease something, ultimate effect goes to retained earning. Now this is, I'm going a little bit away from the topic. But that's very important thing to explain. Let me tell you, what do I mean by everything is charged to retained earning? I said everything goes to retained earning. What does that mean? It's important. It will take me just 2 minutes and I will show you what do I mean by here. You've got here your non-current assets. And then you have got here your current assets. Here you've got your, I don't know, liabilities. And here you've got your equity, okay? And liabilities could be non-current liabilities, current liability. I just write down this much. And within equity, you have share capital, you have share premium, you have retained earnings, and you have reserves. Okay, that's how it is. And the sum total of this is 3,000, and probably this is 3,000, which consists of liabilities of 1,000, and the total, the sum total of your equity, I will call it sum total of equity is 1,000. I put it on the top so that I don't put in front of retained earnings. Now this is my here, and I can say, okay, my non-current asset, I can call them 2,000, and I call current assets as 1,000. Now, if you find out that in past, probably, or maybe some of your assets, they have, you have to write off some asset. There is some asset on the balance sheet which does not exist. The asset was lost last year. It is no more in control. It is lost. It's not available. What do? Asset is not available. It is lost somehow. You never noticed it. Now you notice it, so you just have to remove it from the balance sheet. So asset was $100. So this 2,000 now should become 1,900. Okay. When it becomes 1,900, this value will become 2,900. And if your asset is lost, you cannot decrease your liabilities. You cannot go and tell your supplier that because I lost my asset, I'm not going to give your money. What you need to do, you have to do minus 100 from here. And where you should be doing minus 100? From your retained earnings. Minus 100. Decrease the retained earnings. Then you make an increase in your asset. You do some revaluation, and your asset goes up with 200. When you add an asset here, now this becomes 3,100, and you need to make this also 3,100, and you put 200 there into your reserves. You add it here. Probably there is some impairment. Again, the value of asset will go down. So all of these things are ultimately will be reflected in the equity section. Many of them going to retained earnings, and only the reversal and other thing go to reserves, that revaluation. But whenever you decrease something from the balance sheet or increase something in the balance sheet from the asset side, it ultimately is reflected into your equity section. Okay, so we move to the next. So IAS 8 addresses the following situations: the selection and application of accounting policies, which means how do you or when do you recognize assets, and how do you value assets? Are you going to do it on cost model, revaluation model, etc.? And changes in accounting policies, changes in estimates. So definition: accounting policies are the specific principles, bases, conventions, rules, and practices applied by an entity in preparing and presenting the financial statements. Whatever rules, conventions, bases you are using. For example, an entity may have the following accounting policy in relation to its plant and equipment. Plant and equipment are carried at historical cost less accumulated depreciation and impairment losses, with the depreciation charge presented as part of the cost of sales. So what you said here in your accounting policy, that we are going to do it on cost model, and any depreciation charge will go to cost of sale. So that's your accounting policy. I mean, you have to decide that depreciation will go there in cost of sale, and asset I'm going to show it on cost model. Also, an entity may have the following accounting policy in relation to its building. Buildings are carried at revalued amount, less accumulated depreciation and impairment losses, with the depreciation charge presented as an administrative expense. So the way you are performing your accounting, it is not like somebody is verbally giving instruction to each other. Like if tomorrow one accountant joins your company and he is responsible for doing that reporting and whatever financial accounting department he is, how do you tell him, what to do and how to do? It's not that I will sit down with him and I will, every time he will ask me, okay, how do you do this in your company? And I start explaining him, this is how we do. I will hand him over my accounting policy. Go and read it. Also, it's like your user manual. It's like a user manual of your accounting department. You call it accounting policy. So generally speaking, the entity will determine its accounting policy for each item in the financial statements, which are relevant to IFRS. Whereas where there is no IFRS standard relating to a particular transaction or area, then management should use their judgment in order to develop and apply a policy which will result in information in the financial statement that is relevant and reliable. So management should consider the following when making their judgment. The requirement, okay, this is forget about it. So once an entity has selected an accounting policy, it should be applied consistently to all transactions of a similar nature. Like when you say that I'm going to charge reducing balance method for motor vehicles, then all motor vehicles will be reducing balance. It is not possible that some motor vehicles will be reducing balance, some will be straight line. Similarly, if you say that I'm going to use straight line method for depreciating my building, then all the buildings will be used by straight line method. Or maybe if you say that I'm going to revalue my buildings, then all of the buildings will be revalued. It is not possible that you make, cherry picking, or you make selection that, okay, this building I will revalue and that I will not. Everything will be revalued. So you make your accounting policy and apply it to similar nature during the same accounting period. The same accounting policies should be used. The same accounting policies should be used by the entity year on year in order to enhance the comparability of financial statements. So you should not be changing your accounting policies. Whatever policy is 2009 goes to 2010. So that comparison should exist. Otherwise, you will lose comparability. An entity should not change its accounting policy. Okay, accounting estimate you can change, but accounting policy should not change without a good reason. And what could be a good reason? That good reason is defined by IFRS. IFRS clearly tells you. A change in accounting policy should only be made if Number one, the change is required by an IFRS. So a new IFRS has come in, like IFRS 16 leases come in. So before you were doing IAS 17, you were treating it as an operating lease. Now you have to create a right of use asset. So that's a requirement by IFRS. So you must change your own policy. So either a new IFRS comes in, or the change will result in the information in the financial statements being reliable and more relevant. That's another factor, that there is not an IFRS comes in, but the thing is that you realize that the way you are doing business now, probably it is the existing accounting policy. It is not, helping you to present the information fairly, accurately, and completely. So if you have this understanding, and of course you have to justify to your auditors that I'm changing my accounting policy because I believe that this existing accounting policy is not capable of helping me preparing my financial statements, which are transparent and accurate. And by the way, there is one more thing. It is also possible that with the passage of time, your scope of business or nature of business or way of doing business has changed. And when that way of doing business has changed, or the scope or nature of business has changed, you may require to change the accounting policy also. A good example of the first category is IS-23 borrowing cost. Previously, there were two allowed accounting treatments in relation to borrowing cost. An entity could choose to capitalize borrowing cost, or an entity could choose to recognize them as expense. So previously, you could have done that. The accounting standard was amended and withdrew the choice of recognized borrowing cost as an expense. So consequently, any entity which had previously recognized borrowing cost as an expense would need to change their accounting policy and capitalize them. And you can consider the example of IFRS 16 also, because under IAS 17, the leasing, you were treating it as operating lease and you never put it into the balance sheet. Now, after IFRS 16 has come in, all those operating leases, most of them will become right of use asset, and you have to take them onto the balance sheet as right of use asset and a lease liability on the balance sheet. So you need to change it because IFRS has changed. Accounting for changes in accounting policy, unless the transitional provisions, okay, I don't need to speak about it. This is something which we already have spoken. It's the same thing coming up. Restating the, okay, now accounting for change in accounting policy, as well as restating the comparative amounts, it is also necessary to adjust the opening balances of each effect component of equity. Okay, let's go back and read that thing. That's important. I think I don't want to skip that. So how do you do that? It says that unless the transitional provisions in the new IFRS prescribes otherwise. What does that mean? I will tell you. A change in accounting policy must be made retrospectively. So usually you make a retrospective application. Retrospective application means that, when you got the asset, let's suppose that you got an asset for 20,000 and you say, I will charge 3,000 depreciation. This is net book value. Then I'll charge 3,000 depreciation. This is net book value. Then I charge 3-year depreciation. This is net book value. You were using the straight line method, let's suppose. Now, if at some point in time you say that I need to change the accounting policy from, so in year 3, in this year, you decide to not to use straight line, but you want to use the reducing balance method. So if you are changing the accounting policy, what you are required to do, you need to make a retrospective action, which means that you have to go back and start calculating retrospectively the depreciations for the previous period as well. And as if it said that retrospective, as if the policy had been like this from day 1. So actually you are changing your accounting policy in the year 3 about depreciation, but you must go back and make the change retrospectively, which means year 1, year 2 depreciation, you should also recalculate. And as if the policy had been there from day 1. This is retrospectively. But it says that unless the provision prescribes otherwise, which means that there are certain cases in which IFRS allows you to do not retrospective, but you can only do prospective application. Prospective application means that, okay, from year 3 onward. In year 3, we decided to change the accounting policy about depreciation of motor vehicles. So let's suppose that IFRS allows you, then you can do prospective. Prospective means now and future. But in most cases, you should assume that when you make a change in accounting policy, you must be doing a retrospective application. Okay. So this means that the entity will need to restate comparative amounts for each prior period presented as if the accounting policy had always been applied. So the previous years, year 1, year 2, you need to restate their profits. That if I had adopted this policy from year 1 onward, so year onward profit would have been like this, and year 2 profit would have looked like this. So you restate it. Essentially, the entity would need to redraft the comparative amounts using the current accounting policy. So whichever you have current, you take this new accounting policy and then go back and start making retrospective application and finding out what the depreciation would have been if the policy had been there from day 1. As well as restating the comparative amounts, it is also necessary to adjust the opening balances of each effect component of equity, often retained earnings. And of course, let's suppose if I'm calculating my reducing balance method, you know that in reducing balance method, what would I have done? Let me show you. Motor vehicle was 20,000. I was calculating straight line 5 years, 5 years straight line. Probably I charge 4,000 depreciation. Okay. I said it will become 0 in 5 years, 4,000, 4,000, 4,000. If I move to reducing balance and I say I'm going to charge reducing balance 25%. So 25% reducing balance means that here the depreciation is 5,000. So you charge depreciation less. You should have been charged with 5. So what you should do in year one, your retained earning, you should make a debit. You should make a debit of retained earning by 1,000. You should decrease retained earning because you charge less depreciation. As a result, retained earnings were more. So when you take, instead of 4, you increase the depreciation expense, the retained earning would have been less. So you decrease the retained earning with 1,000. So adjust the balances and include the adjustment to opening equity as the second line of the statement of changes in equity. So any changes which you make, you show them separately. Okay, so disclosure requirements, pretty simple. Usually disclosures are not part of your F7 exam, not even SBR. They don't ask you to make disclosures, but what disclosure notes you should give. The nature of the change in accounting policy. I mean, what accounting policy you changed. The reasons for the change. That's very important. Why are you changing it? And the amount of the adjustment for the current year and each prior period, and the amount of the adjustment to periods before those presented. So when you are making a change in accounting policy, you must show the reason, and you also must restate, you also must show the effect of this change. That if I'm changing this, how much the retained earning will be impacted, how much will past year retained earning, how much this year profit and loss will be affected, and what will be the effect on SOFP. So you have to show these numbers so that the shareholders would understand that are you trying to manipulate with profits by using the accounting policy, or what? Why are you using it? And if you are using the reasons are valid, then what would be the impact on the final numbers? So this is one example. I will leave it. You have the slides. I will upload them. You can read it by yourself. So there is some long example. It's an exam question. So I'll skip this thing. Usually you do slides, download, and you do the questions. So then comes changes in accounting estimates. So that's not very tricky, okay? A change in accounting estimate is an adjustment of the carrying amount of an asset or liability of the amount of the periodic consumption of an asset that results from the assessment of the present status of and expected of future benefits and obligations. So pretty much difficult definition. You can assume that your estimate is like 5 years residual life, a 5-year useful life, 20% residual value. These are called your estimates. And you can change them, by the way. So estimates include changes in the allowance for doubtful debt. Like previously you were doing 2% allowance. Do you think that 2% is not enough? Let's make it 2.5%. Or changes in adjustments for inventory obsolescence. You think that 3% of the inventory becomes obsolete. Now it is not probable, you make it 2%. Changes in the estimated useful lives of or residual values of non-current assets. Or changes in warranty obligations. You generally can change all of these things because these were your estimates before and you have a right to change them. These changes result from new information. Changes in accounting estimates are applied to prospectively. So if you make a change in accounting statement, you do it prospectively. You don't need to do retrospective. For example, I was charging depreciation 4,000 on my asset, 4,000 in the second year. And then what happens? In year 3, I change the life of the asset. I decrease the life of the asset because I believe that the asset will not last so long. So as soon as I decrease the life of the asset, my depreciation for year 3 will go up. And if the depreciation for year 3 goes up, you don't need to go back and change here because here it was more. Here it was 5 years. Then you said it will be 4 years. So at that time, it was your estimate, it was correct. So you do it prospectively. There is no need for doing retrospective. Retrospective you do for accounting policies. Then comes changes in accounting estimates. Disclosure, the nature and amount of the change in the accounting estimate that affect under or future period must be disclosed. So you just disclose that with reference to this change, how much impact is coming on financial statements. Then you have errors. So 3 things we discussed: accounting policies, estimates, and errors. Errors are prior period errors, are omissions from and misstatements in the entity's financial statements for one or more prior periods arising from a failure to use or misuse of reliable information that was available when the financial statements were authorized for issue, and they could reasonably be expected to have been obtained and taken into account in the preparation. So it means that the rules were there, policies were there at the time of preparation of financial statement, but you could not apply them properly. But they were reasonably probably, they were possible to be applied. You could not. So that's why you call it error. Okay. I mean, that is why you call it error. Error means that I should have calculated 5. I knew that, but I calculated 4. So now I'm making a mistake. Okay. So this is what it says here. So what do we do? Errors may arise from mathematical mistakes, errors in applying accounting policies, oversights, you just ignored something, misinterpretation of the facts. Misinterpretation of the facts. I mean, I tell you a very common thing. Let me tell you. I create, and usually what happened, and I'm going to give you a real life example. We purchase some equipment, and I'm telling you the real numbers actually. I'm going to tell you real numbers for approximately 9 million, okay? So we purchased this equipment for 9 million, and then we had some transportation. And that transportation we made for probably, I can tell you, it was 425,000 USD because it was it included the sea and the road transport. and insurance. It was a huge equipment. And then you have your customs duty. So you paid some custom duty. I don't remember how much we paid custom duty. Then you may have your, how to say, your VAT. We paid some VAT on that, but our VAT was recoverable, so we did not add. And then there was installation. And I'm going to tell you what error we made. And that was your installation cost. The engineers, they came in, they stayed for 15 days and did it. This was the last item, which my accountant, he forgot. What we did, to install this machinery, we prepared a shed. That was like a platform, like a concrete platform, a platform which was made of concrete, and we put the equipment on the top. Now, when he made that platform for concrete, we spent some money, $5. And what he did by mistake, he took this platform, concrete platform on which this equipment was placed. It's not like in a factory, it was something, a separate thing. He just took this amount to land and building. He said it's a construction thing. It's not equipment. It's not plant and machinery. It is my land and building. And he took it to land and building. Now that was not the correct treatment, and it was a significant amount. It was something like 200K or something we spent on that. It was a very huge, thick thing, like 4.5 meters of concrete, very solid, because equipment was very heavy. It had to be put on that platform, that concrete thing. So that was an error. We only realized it next year. So then what we should have done, we should go back and do what? So this is called misinterpretation of the facts. So there was some fact, but we just were not properly interpreted it. And then fraud could happen. Fraud could happen. Accounting treatment. Errors are accounted for retrospectively. You go back and do retrospective. This is the same accounting treatment as per changes in accounting policies. The financial statement should be restated and presented as if the error had never occurred. You cannot charge it to current year. You cannot take it to the current year. You keep it in the last year. And because last year financial statements you already have published and presented, you cannot make change in the last year income statement. What technically you do, you actually charge you debit your retained earnings. So this is the accounting treatment. So this was IS 8, which was changes in accounting policies, estimates, and errors. If you have any question, you can ask here.